When you look at many income statements, the line item immediately below revenue is often something called cost of goods sold, or cost of revenues, or sometimes cost of sales. I know, multiple names again for the same thing. Very annoying, but it comes with the territory. In this video, we will examine cost of goods sold, how it can be computed, and how it relates to our accounting for inventory. This is probably best explained within the context of a simple example. Assume we have a company that has no inventory to start the year and purchases 5 units of inventory during the year. There's rampant inflation and the cost of the inventory goes up by $1 at each purchase. So you end up with 5 units of inventory, each with a different cost. A $1 unit, a $2 unit, a $3, a $4, and a $5 unit. At the end of the year, you sell 2 units for $10 each. Now you know your sales revenue will be $20, but what should be the cost of goods sold? You know you sold 2 units, but which 2 units? The cheap ones, the $1 and $2 units, or the expensive $4 and $5 units? It obviously makes a big difference in how much net income you'll show for the year. I suppose if every company had state-of-the-art inventory systems with barcoding and electric scanning, keeping track of which particular units are sold at each time, this might not be such a big deal. But the accounting systems have to work for all sorts of businesses, for highly automated ones to manual systems. So to make things a little easier on the firm, the accounting rules allow firms to adopt an assumption about which units get sold, what we call a cost flow assumption. This cost flow assumption does not have to match the physical flow of goods. Firms can still manage the physical flow of goods however they want. But when it comes to figuring out which inventory units have been sold so they can compute cost of goods sold and the remaining ending inventory, firms can pick one of 4 cost flow assumptions with the requirement that they stick with the same assumption year after year and apply it on a consistent basis. The 4 cost flow assumptions are specific identification, which is what you might use if you had one of those state-of-the-art high-tech inventory systems, average cost, first in, first out, and last in, first out. Since specific identification is pretty self-evident, I won't discuss that method, but will illustrate the other 3 methods using our simple example. First, a look at average cost. In this method, an average cost for the year is calculated by taking the total cost of all goods in beginning inventory and purchased during the year, in this case $15, and dividing it by the total number of units available, in this case 5. The average cost of $3 is then applied to both the units sold, giving us a cost of goods sold of $6, and applied to the units remaining in inventory, 3 units at $3 each, or $9. First in, first out, or FIFO, assumes the oldest units are sold first, leaving the newer or more recent purchases in ending inventory. In our example, cost of goods sold would be assigned the $1 and $2 units for a total cost of goods sold of $3, leaving inventory with the $3, $4, and $5 units for an inventory valuation of $12. Last in, first out, or LIFO, makes the opposite assumption from FIFO. Under LIFO, the most recent purchases are assigned to cost of goods sold. Here are the $5 and the $4 units for a total cost of goods sold of $9, leaving inventory with the older purchases. Here are the $3, $2, and $1 units for an inventory value of $6. You can see the difference the cost flow assumptions can make on your gross profit and net income, as well as on the inventory valuation that shows up on your income statement. Thus, firms are required to disclose what cost flow assumption they're using. At the same time, it's important for investors and analysts to understand this as well so they can properly interpret the amounts they see for cost of goods sold, gross profit, and inventories. I should also point out that LIFO is allowed under US GAAP, but not under IFRS. LIFO was developed years ago as a tax reporting method that would allow firms experiencing consistent inflation to show a lower gross profit, as you see here in our example, and thereby minimize their tax liability. However, this is just a temporary deferment of the tax because, as you see here, when those low-cost units in inventory eventually do get sold, there will be a much higher profit realized and higher taxes to be paid as well. Now that we understand the cost flow assumptions, let's look at the journal entries for inventories and cost of goods sold. First, the purchase of the inventory is pretty straightforward. Here, inventory is purchased for cash, so cash decreases by $15 and inventory increases by $15. In the accountant's lingo, we are capitalizing the $15 cost as an asset, inventory, until the units are sold, at which point we will expense the cost of the units sold according to the cost flow assumption we've adopted. When you sell your product, it's important to realize that we record the sale and cost of goods sold as two separate entries. We do this because we want to show the selling price on the income statement as revenue separately from the cost of goods sold, and not just show a single net amount of the difference between the two. The sales entry we've now seen before. We record the $20 selling price as revenue with the associated increase to net income and retained earnings. And if we assume this to be a credit sale, there'll be an increase to accounts receivable. The cost of goods sold entry accounts for the reduction of inventory and the recognition of the cost of goods sold expense. Under the average cost assumption, the units sold are costed at $6, so inventory is reduced by $6 and an expense of $6 is recorded. This $6 expense causes a decrease in net income and a decrease in retained earnings. When the customer pays their bill, cash increases by $20 and accounts receivable decreases by $20. Some final thoughts. Most firms use the average cost or FIFO methods, with LIFO only used in the U.S. and primarily by firms that have experienced significant inflation in their inventory at some point in their history. Firms cannot switch cost flow assumptions from one year to the next. They need to keep applying the same methods from year to year. It's probably occurred to some of you that if your firm doesn't sell a product, but rather sells a service, it won't have inventories and therefore no cost of goods sold. This is true. But many service firms will still compute a cost of services, which can include things like the labor cost of those employees that deliver services to their customers. All of which points to the importance of reading the footnotes, the financial statements, which is where the firm will explain the methods and assumptions it uses when accounting for the sale of its products and services.